Welcome to this video on options pricing. After completing this video, you will understand the need for an options pricing model and understand options pricing with the help of a toy binomial model. But first, why do we need a pricing model? Plenty of instruments get traded without a model. Why not just buy a call if we think the market will rally beyond the call's price? Or, why not bet on volatility by trading straddles? A model is not completely essential, but it is helpful. It's like a map, it simplifies the world. We don't want it to be perfect, we just want it to be useful. Here you can see a satellite image and a map of the same place, both sourced from Google. The map is less accurate, but much more useful. An option pricing model lets us compare options with different strikes, expirations, and underlying assets. It reduces the information from thousands of quickly moving options prices into a few slowly moving parameters. Take the simplest possible example. We have a $100 stock that in the next period can go up to $150 or down to $90. The levels of 150 and 90 have been selected arbitrarily, solely for the purpose of illustration. So what is the 100 call worth? Let's find out. To do this, we create a hedged portfolio that includes both the call option and a certain number of shares of the underlying stock. Here, H represents the number of shares, and S is the price of shares. We don't know the value of H yet, but we know it is possible to create such a hedge by shorting the stock. So in this case, we are creating a hedged portfolio by buying a call option and shorting its underlying asset. If the stock goes to $150, the call expires $50 in the money. So our portfolio is worth 50 minus 150H. If the stock goes to $90, the call expires worthless and our portfolio is worth 0 minus 90H. For us to be hedged, we need to be indifferent to these states. In other words, whether the stock price goes up or down, our position should be the same. So minus 90H equals 50 minus 150H. When we simplify this equation, we get H equals 5 by 6. Further, if we replace the value of H at $150, our portfolio is worth 50 minus 150 multiplied by 5 by 6 equals minus 75. At $90, our portfolio is worth minus 90 multiplied by 5 by 6 equals minus 75. Because the portfolio is hedged, we won't make any money, so the initial value of the portfolio is the final value, that is, C minus HS equals minus 75. Therefore, when we solve for C, we find that it is equal to $8.33. Note that this model is just a stylized example and does not represent any real situation. More important than what this number is, we should know what it is not. It is not the average value of the values of options at $150 and at $90. We don't even know the probabilities of going to each of these prices. Since our portfolio is hedged, the stock's returns don't matter. The option is worth the same whether the probabilities are 50-50 or 99-1. Once we have hedged directional risk, the stock return doesn't matter. But the spread of the stock's final values does matter. They don't matter because we took action to make them not matter. Because this risk can be hedged, options traders are not compensated for it. This concept is called risk neutrality. In the risk-neutral world, we can assume that the final value of the stock is the initial value of $100. Therefore, the call option value is determined based on the assumption of risk neutrality and the associated probabilities, rather than relying on the actual stock returns, because the risk of those returns has been hedged. This model illustrates a very important concept, risk neutrality. But it is too simple to use in practice.